Furry Hippo Finance. We're going to go through here, guys. I want to ask some of the financial or answer some financial questions. And I'm going to go through the top 10 financial questions that I have over on ChatGPT. So it's going to be pretty cool to see, guys. Again, this is the very first live stream that we have ever done. I hope it's going to work properly. It might be an absolute train wreck, but we will see if we do get anyone in here and we do check out this live stream. So number one, guys, how do I create a budget and stick to it? Now, this again is probably one of the most important questions that I see when it comes to budgeting. It is really important to have a method that works for you, whether it is an application, whether it is a bunch of different ways you can actually do this. They can do it through apps. I recommend doing it through pen and paper. Now, pen and paper, of course, you're writing down everything. You're really sticking to a budget and you're putting down on paper. It gives you kind of the psychological aspect of writing it down and seeing it, adjusting it is a lot more time consuming on that aspect. However, when you're in there, guys, and you're writing it down, it makes a big difference when it comes to the realization of the numbers. When you're writing down what you're making every month, every week, really breaking it down again, however you do budget. And there's a lot of different methodology behind this, a bunch of different ways. You can use the 50-30-20 rule. You can go ahead and you can break it down with the zero-based budgeting, which I do. And if you have questions, guys, just go ahead and drop them into the chat and I will take care of them. But like I was saying, guys, the 50-30-20 rule, 50% of your income goes into your needs. So that is really a bucket. And we've seen that this budgeting method seems like it's slowly phasing itself out as we see inflation gets higher, as we see, things within America get more expensive. Rent is going up, mortgages are going up. The need category for 50% of income means you need to make $4,000 to $5,000 a month to really have it viable. If you're in the $2,000 to $3,000 range, unfortunately, the 50-30-20 is not really going to work for you because that other next category, the 30%, is the wants. So with the want category, again, it seems like that want category is going to come in a little bit lower. It's going to have to because you're going to have to go over that 50% in that needs category. And 20 is really the saving, the debt repayment, the investing portion of it, which again, if you're breaking out everything that you have within a budget itself, chances are the 50-30-20 is not going to work. But like I said, guys, I do the zero-based budgeting method. Now, this is personally my favorite. So what it does is it takes your income minus all of your expenses, and then you see what is left. Now, this does take a little bit of time to get used to because essentially if during the month, let's say I'm making $5,000, I get all the way down to I cover all my needs, cover all my wants, cover all my expenses. But I get to the point of where I have a couple $100 left at the end of the month. I have something to do with it and I know exactly what I want to. Me personally, guys, I've been putting it towards our mortgage. That way we can pay it down, pay it off, and be completely debt free. With a couple more years until I'm planning on retiring, hopefully it's going to work fundamentally that we have enough in investment accounts, that we have enough saved, and that we are completely debt free at that point, which again is going to be super important to get to that point. Now, number two, guys, what is the best way to save for retirement? For this one, guys, retirement planning is a major concern for a majority of Americans. Optimizing savings accounts, optimizing retirement accounts, but how can you really do it? Personally, it is the pay yourself first. Now, we've talked about this before. That means that before you bring home the paycheck, before you look at the needs, before you look at the wants, before you look at everything, you're going to end up paying yourself first. So again, what does this mean, guys? I'm going to take a X amount of dollars that is going to go into an investment account, and that is going to be it. So again, we're using that kind of baseline of the $5,000. So if I have the $5,000, I want $300 to go in an investment account. That is going to be earmarked or saving for retirement. This could be a 401k plan. This could be an IRA. This could be a multitude of retirement plans. But again, if you're not starting to save for retirement, or if you're overspending on the daily expenses, you're going to see that you run out of money when you get to the end of the month. There's literally nothing left at that point, or you have to borrow to make up essentially what you're not covering on your monthly expense basis, which if you're running it for long enough in the red, you're going to find, guys, that you run out of money, or it gets to a point where your credit score is affected. If it gets to the point where you cannot borrow any more money, then you're in dire straits much more than you were. Now, one thing to note with the retirement plans, guys, is you have to keep the money set aside if you're taking money out of it, if you're doing loans out of it, if you're doing withdrawals from those retirement accounts. Majority of time, they do come with fees, they do come with expenses, they come with a lot of things that are going to be detrimental to your retirement. Not only negating the compounding interest in the earnings that you can get from the retirement accounts, but also you're really putting your retirement in jeopardy. Now, again, with that being said, guys, you have to save for retirement. I cannot stress this enough. 15% is the target. If you start right off out of the gate, when you start your first job, you have minimal debt, you have minimal expenses. If you're putting away 15% when you start, that means everywhere you go, every job you have in the future, everything you're looking for, just keep it at that 15%. If you get a pay raise, let's say you get a 3% raise, 5% raise, 48% raise if you're in the UAW, which is kind of insane, but when you do get that raise, keeping that 15% locked in is just going to increase over time. Now, question number 3, how do I get out of debt and improve the credit score? Debt management, debt credit score improvement are vital for the financial stability, which is why we focus on the financial literacy. The more you know, we see a ton of questions and a lot of guidance that we have to provide around tackling debt and building the credit score, which is kind of funny because these do go hand in hand, guys. When you're looking at getting out of debt, when you're looking at improving your credit score, most of that comes with the elimination of credit card debt, and most of it comes with making on-time payments. So when you kind of break down your credit score, 35% of it, guys, the biggest bucket of your credit score is invested into on-time payments. If you miss a payment, unfortunately, it does take out about 24 months of on-time payments if you have one single late pay, which means it can really be detrimental to your score if you do have one of those late pays. Now, what is going to take care and what is going to fix this late pay? You can ask the institutions, you can ask the creditor if they can take care of that for you. Some do, most of them will not work with you because you were late. But with that being said, it is going to take time, guys. A lot of places that say, hey, we can repair your credit score for, a couple $100 and your credit score will instantly be better. It doesn't exist, guys. It really doesn't. Credit score is an evaluation over a certain amount of time. When you have that time built up, that will be the point that you can actually improve your credit score. Now, in addition to that, guys, 30% is the capacity on your cards, meaning that is the available balance that you have in correlation to the amount that you have borrowed on that card. The higher that you have that limit, the higher that, and the closer that you get to that limit, the bigger impact and bigger negative impact that you're going to see on your credit score itself, which again can be super detrimental when it comes to improving your score. Then, of course, the rest of it, kind of the mix of credit, the inquiries for credit. There's a couple other buckets that make up the credit score. But when you look at the on-time payments, and then when you also do look at the second bucket, which is the capacity of the cards, that is 65% of your credit score, guys. That is a bulk. That is a majority of the credit score that we do have within there. Getting into question number 4, what are the different types of investment options? Which one is right for me? This is going to be super dependent on a couple different factors. Number 1, going to be your age. Now, this is going to be a big factor because you're going to have different investment options or different strategies. If you're 25, if you're 45, if you're 65, it is going to be entirely different strategies that you're going to rely on. However, when you look at the longevity and when you look at the amount of time you have to investing, you can invest in stocks, bonds, real estate, mutual funds. You can invest in art. You can invest in REITs, which is, of course, real estate. There are a ton of things to invest in, and really diversification does help a lot. Personally, if you guys checked out the VOO video, so we actually have one on the Vanguard, the S&P 500. I invest heavily into the VOO, that Vanguard fund. The reason being, it is entirely in the 500 largest companies within the United States, which makes a huge difference, guys. So you are literally splitting your investment strategy and splitting those investments over every single sector of the stock market based on the 500 largest companies. Now, the VOO and the S&P 500 will also change companies depending on companies that are worth more, that do grow bigger, and some companies that fall off because, again, it is the 500 largest companies within the United States fall into that S&P 500 fund. Number 5, guys, how can I reduce my taxes legally? So minimizing taxes is always a concern for a lot of people, guys. Speak to a tax advisor about it, but there are a lot of regular deductions, a lot of credits, and a lot of strategies that you can utilize when it comes to eliminating and really mitigating some of those taxes. I'm going to go over a couple of those that I personally use. Number one, contributions into the 401k. So what we do is my wife and I, we actually put a substantial amount into our 401k. With that being said, the money in a 401k is a write-off for taxes. So if you're making $100,000, we put 20k into a 401k. That means that we are taxed on the 80% that is remaining if you're doing it into a traditional 401k, meaning there's $20,000 currently that I do not have to pay tax on. Trying to get kind of into a lower bracket makes a big difference. You can also do this with traditional IRAs, but one of the biggest tax advantages that we see, which is considered the triple tax advantage or the 3 times tax advantage, guys, is if you have a high deductible healthcare plan, you can actually invest in HSA accounts. So HSA accounts are for medical, but it doesn't just stay just at medical. It can be copays when it comes to utilizing doctor's visits. When you look at anything that is health related, even as far as buying band-aids, buying Advil, buying aspirin, buying things of that nature, are eligible for an HSA. Now, when you start getting up in age and when you start getting to those retirement years, overall, they say it's about $6,000 to $7,000 per year that individuals of retirement age spend, which means if you can build up those balances and build up those balances pretty high in those HSA accounts, the money is already going to be there when you need it. If you don't build up the HSAs and if you're not eligible for it, they have FSA accounts, but you have to be and really know what those accounts are about, because most of the FSA accounts actually require you to spend the entire balance that you make the contributions in there, which again can kind of change depending on your tax situation and kind of where you're at. What is the best savings for my child's education? This is number 6, guys, and this is a huge one. Overall, saving for a child's education is probably one of the most overlooked things when you look at debt consolidation, when you look at debt repayment, when you look at saving, when you look at retirement accounts. Most of the child's education is really put on the back burner, or it's a couple kind of rungs down the list, as we've seen it before. So you might go in there and you might say, hey, I want to save for my kids. What is the best way, guys? It is for us the MESP program, and there is a lot of different changes that are coming, the 529 plans, the education savings accounts, but the MESP plan is actually going through currently a lot of different changes that I did want to cover some of those. Now, the current changes that are going on with this starting in 2024 is if you have an MESP plan, and you're setting away money for your child's education. Let's say over the term of this MESP plan, you put in $20, $30, $40,000. They are going to have the ability where if your child does not use that for education, or if there are still funds in that MESP plan, and I believe it was after 15 years, you are going to be able to, as the custodian for that MESP plan, you're going to be able to use that as a Roth for yourself. That is right, guys. The MESP plan, if it is not utilized, if there's money in there after a certain amount of time, it becomes a retirement plan for the custodian for the child's education, which can be huge, guys. That can be another bump why you should put more money into that MESP plan. And you know what? Worst case scenario, you might have a child that uses the money. Great. Absolutely perfect. The money was used as an intended. You were saving up for your child's education. Your child used it for education, which is exactly the reason and the logic behind why you wanted to do it. Number 7, guys, we get in, should I rent or buy a home? The decision to buy a home is very, very significant, and it comes with a substantial cost, and costs that a lot of people do not realize. When it comes to principal, when it comes to interest, when it comes to taxes, when it comes to insurance, that is just the basics of buying a home. That is made up by the payment that you're going to be making to the financial institution or the lender that does hold the mortgage for your home. But in addition to that, guys, owning a home like I do, you have your utilities, which can be a lot. You have your internet, you have, if you still have a phone, if you need repairs, if you need upgrades, if you need a new furnace, if you need a new air conditioning. There are an incredible amount of things that go into home ownership, which again, I feel like a lot of people do not really realize or set aside money. Personally, again, we're putting aside, I think at this point, it's $100 a month for home repairs, for renovations. So when the time comes, when we need a furnace, when we need repairs, when we're doing updates, we already have money set aside that is going to be earmarked for those renovations. Now, of course, you don't have any of this if you are a renter. There are a lot of people that rent and a lot of people that love to rent. For a majority of places, they will cover the heat, they will cover some of the expenses. Some of them even cover the heat, the electricity, they cover the water, they cover a majority of things, which means your only obligation is paying that monthly rent. Where in the case of a home, if you decide you don't want to be there, you're going to have to list it, you're going to have to sell it. There's going to be costs associated with it. And also knowing and figuring out what the home is worth, what you can get for the home based in the current state. That is why a lot of people like to rent. Also makes a big difference, guys, depending on what market you're in. A lot of people do like to rent, and it is a pretty tough decision. I like the fact of home ownership, that you have something that is yours. But again, a lot of people don't want to commit to a location or don't want to commit to the cost of home ownership itself. Now, again, it does come home ownership with a very significant cost, including a down payment, which is where a lot of people kind of struggle with. And even looking at houses today with higher interest rates, looking at a 30-year mortgage, it's about 8.25%, which again is a pretty high rate as we've seen it and as we've seen it over the last couple of years. But with that being said, home values are still incredibly high. And I just think of my local area. We're just north of Detroit. But when you look at houses, let's say 5 years ago that ran $100,000 for kind of a starter home, maybe a fixer up, maybe a 2 bedroom or 3 bedroom home around this area. Overall, right now they're about 185,000 for those exact homes that were roughly 100,000 about 5 years ago. So again, the home prices are still high within a majority of markets, and some of them are even much, much higher than what we're seeing right now within the market here in Detroit. Number 8, guys, how can I build an emergency fund? How can I save money? Emergency fund is number one. We have talked about this before, guys. It is really number one to build up the emergency fund. It is really the essential. It is the basis. Also, it isn't incredibly difficult. When you look around your house, when you look at different places, guys, you could probably find enough stuff to even sell different places, depending on what you have, to fund that emergency fund. Even if you're at the point where you're paying yourself first, you're putting away $50 a month, you're putting away $100 a month, whatever it is, guys, building that emergency fund, you are looking for $1,000. That is really the basis and the point that you want to get to. Once you get that first $1,000 into that emergency fund, from there, you're going to start the debt repayment phase. If you've ever been a fan or seen Dave Ramsey's 7 baby steps, it is super, super important. A true emergency fund, 3 to 6 months of savings in a savings account, high yield savings account. Absolutely want to keep it liquid if anything does happen. But the basis for the emergency fund is having the ability to cover emergency expenses in case one does occur. Now, for a majority of people, the emergency fund is based on, hey, I have a credit card that has a $1,000 limit. That is what I'm using for my emergency fund. If anything happens, I'm going to use that card. Chances are you're not going to be able to pay that card off within the month that the emergency happens. So now instead of paying X amount of dollars for that emergency, you're going to pay even more for that emergency because you didn't properly set up the emergency fund. And again, from the financial counseling aspect, this is the basis, guys. If you can save more than 1,000, great. Then we move on to the couple other steps kind of down the road. But building the emergency fund is priority one, followed by the debt elimination method. When you pay off debt, when you eliminate that debt, guys, it gives you more money. When you look at the single biggest and the most important tool that you have in your toolbox, it is your income. That is your liveliness. If you want to travel, if you want to go on vacation, if you want to make purchases, if you literally want to survive with food and housing as your primary needs, you are going to have an income. And I don't want all of your income being eaten up by credit card debt. I don't want it eaten up by expenses like high payments for auto loans. Auto loans average payment right now in 2023 is running around $650 a month, not including insurance, which in my opinion, guys, is just absolute insane. It was even sticker shock when we went to buy our vehicle a couple years ago. We put a considerable amount down to get the payment where we were comfortable with. And then we paid it off in a little less than 2 years, which is exactly what you need to do for that debt elimination. Number nine, guys, what is the best strategy for paying off my mortgage early? Now, this is one, again, that is going to come far down the line when it comes to the mortgage and when it comes to paying off the mortgage early. The only time that I would advise this and the only time I would really look at paying your mortgage down early is simply if you have no other debt. So, literally, you have no credit cards, you have no auto loan payments, you have no debt in your entirety. And on top of that, you're doing two other things. Number one, you're putting that away, that 15% into an investment account or retirement account. And number two, when you're at that point, you're also saving money in that MESP program, which again is going to be changing in 2024. Super excited for the changes because we do have those MESP programs for my kids. Now, if you're looking to pay off the mortgage early, when you budget it, when you're looking at it, guys, make an extra payment. Make at least one extra payment every single year. When you look at the longevity of a 30-year mortgage, if you're making one single extra payment every single year, you'll roughly cut off 5 to 7 years of your mortgage, which is kind of crazy to think, but that is the impact that it has when you're paying off the mortgage. So what is the best strategy? Principal payments, guys. Anything that you can put in, the more that you kind of get into this with the mindset of the debt consolidation, with the mindset of paying the debt off, paying the mortgage off early, investing, you'll see it's almost like a psychological snowball effect where I look even with the zero-based budgeting and I think, how much can I put into an investment account this month? How much can I set aside to pay off my mortgage early this month? Where are we sitting and how much do we have left at the end of the month? That might mean eliminating Starbucks, eliminating snacks, maybe bringing your own lunches, bringing your own food. Really puts it in perspective when you want to pay off the mortgage early, when you want to pay it off, when you have a deadline for it. We've always said when it comes to finance, when it comes to financial planning, it is super imperative, guys, that you go in with a strategy and you know exactly what your plan is. If you have a 30-year mortgage and you said, you know what, I want to pay this off in 15, I want to pay this off in 20, regardless of your time frame, I want to retire in X amount of years, write it on a sticky note, put it on your computer, put it someplace on your bathroom mirror that you're going to see it every single day and that you are going to go ahead and you're going to hit that goal and you're going to achieve that goal. And the final one that we get to, guys, how can I start investing with a small amount of money? This is something that we get when it's funny because I actually had someone who came in. They said a lot of people are talking over on TikTok. I'm seeing a lot over on Instagram that I need to be investing. The individual was 20 years old. I have money in a savings account, but everybody keeps telling me that I need to be investing, but I don't understand the strategy and I don't understand how do you physically invest? How do I get the money from point A? How do I get the money into point B? What is the goal and how do I actually do this? Now, when you look at the fintechs, when you look at a lot of the things that we have right now, even with the small amount of money, you can buy fractional shares. I use personally M1 Finance is who I use for all of my investing. But when you look at Robinhood, when you look at Webull, when you look at a lot of different platforms, guys, they give you super, super easy ability to invest. You can build your own portfolio. You can invest in the VOO like I personally do. VOO, if you go do your research, if you do some of the Google searches, you'll see 81% of financial advisors cannot and have not outperformed the VOO when you look in 5 to 10 years. Kind of crazy to think that you're going to pay monthly fees with a financial advisor. You're going to pay 1% portfolio fees with a financial advisor. Some of these companies even charge trade fees, per trade fees, whether it's percentage based, whether it's a set amount to do these trades. When again, a lot of places you can get it in its entirety for free through a lot of different avenues, guys, that I've kind of talked about. Again, the Robinhood, the Webull, the M1 Finance, a lot of different ways that you can invest money and you can invest as minimum. I think some of them are $5, some are $10, some are $25. So again, even if you're looking to the point of, hey, I want to start investing, I don't have any money. I'm sure most of you, almost all of us guys can put away $5, can put away $10, can put a couple dollars here or there to really, one, build up that emergency fund, to pay down a little bit of that debt or even getting into an investment account. And also, before we're done, guys, I do want to talk a little bit about the 401k and also about the employer match. When you think about the employer match, and again, going back to Dave Ramsey, I don't like the thought of leaving free money on the table. When it comes to the employer match, I think you should, at very minimum, if they're offering 4%, invest your 4% right off the top, guys, before you get your income, before it comes home, before you look at your take home pay based on your budget, and that's what you're building your budget on, that you have a certain percentage that is going into an investment account and it's going there on a regular basis. Now, I know that the pros and cons of it, where they say, hey, if you're sitting on credit card debt, it is going to be much more beneficial to pay off the credit card debt than putting it into an investment account. But you also have to think, if I'm putting in 4%, my company's putting in 4%, that investment grows roughly 8 to 10% over a year. They're putting in their 50%. You're talking about 16 to 20% growth because you're getting the free money that your employer is putting in, which is the way that I see it. Again, finance wise, it seems like it makes sense if you're going in to at least match what the employer is offering. For a majority of employers that I have been with, that I have seen, I have never seen even north of 80% 401k contributions, meaning that when you look at an entire company, you roughly have 20-25% of people who put zero. That is right, guys. They put nothing into an investment account. Even when companies offer matches, they are putting nothing into the investment accounts, which again, in my opinion, guys, longevity wise, retirement wise, you are just sacrificing really the short-term gains or the short-term money for the long-term growth and the compounding interest that you're going to find in there. All right, guys, this is going to end the stream. And again, this is the very first stream that we're doing on Furry Hippo Finance. Absolutely love doing it, guys. Most of you know that I do this as a profession. I'm actually a bank center manager. I'm also a certified financial counselor through the state of Michigan. This is something that I'm absolutely passionate about, and I love talking about finances with you guys. Next time we do this, hope some more people are going to be on here. We actually had a couple different people on here for the stream, so big shout out to them that have joined us over on the channel. We are almost to 500 subscribers. That's right, already. We're almost creeping up and we're almost at 500 subscribers on the channel, which is very, very cool to see. All right, guys, so that'll do it for the stream, and I will